It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hey everybody, it's Mark Yegge. Welcome to another edition of the Wealth Architect Podcast. Glad you're here and glad I have a guest today. It's kind of cool to have a guest. Of course, every week we have a guest, but today we have a special guest who is the founder of Wellings Capital. He completed over 85 real estate investments and exit, appeared on HGTV's House Hunters, rehabbed and managed dozens of rental properties, and developed a subdivision. Now, after completing 3 successful real estate developments, including assisting with the development of Hyatt hotels and a very successful multifamily project, he's finally narrowed his focus to commercial real estate in 2011. And today we're going to be discussing boring investing, one of my most exciting topics, right? Boring investing and other things. Please, I want to welcome Paul Moore. Paul, welcome to the podcast. How are you today?
Mark, it's great to be here. Thank you.
Good to have you. I'm excited about talking about boring investment. I try to put that in an ironic statement, but it is true, and I know this from my own past, that boring is a lot of times better. So we're going to get into that. But first, I want to talk a bit about you and how you got started and how you got quickly from how you got started to quickly to where we are today in your career.
Yeah, so I actually, after 5 years at Ford Motor Company, I sold my company to a public firm in 1997, and I had a little money and I had a lot of free time, and I thought I'm a full-time investor now.
There you go.
And you know what, Mark? I wasn't. I found out later that I was not a full-time investor. I was a speculator, and I didn't know the difference. Investing is when your principal's generally protected and you've
Yes.
got a chance to make a return. And speculation is when your principal is completely unprotected, completely, there's no way to predict whether it'll go up 100% or down 100%. There's no real basis for it, and you've got a chance to make a return. And so I did a lot of speculating in those early years, and I made some money and I lost a lot of money, made a lot of mistakes. Had a podcast for 4 years called How to Lose Money, where we talked about our mistakes and others on the path to success. So that's how I got started. Ended up in real estate, flipped uh, dozens and dozens of houses and waterfront lots at Smith Mountain Lake in Virginia. And like you said, I landed in commercial real estate about 14 years ago.
Wow. And here you are today, helping people figure out how to become boring investors and maybe not be speculators, right? So how do you go
Yeah.
about that, and what kind of projects are you working on today to be able to help them do that?
Yeah, well, I mean, so I view wealth a little different than some. You would think it might be the flashy cars or mansions or whatever you see in West Palm Beach. I think true wealth is having assets that produce cash flow. And Warren Buffett said, if you don't make money while you sleep, you'll have to work until you die. And so, but the problem is a lot of those assets that produce cash flow are boring. When I first started talking to family offices and, wealthier, very high net worth individuals, I would pitch them on a 20% return deal in North Dakota, and they'd say, I don't want that. That's too much. I'm like, excuse me, that's too much? And they'd say, I'm really looking for a 5 or 6, 7% return. Anything above that's too risky for me. And I realized these people were in the mode, where Robert Kiyosaki talks about their cash making cash for them. They didn't need some exciting strategy, some crypto leveraged algorithmic smart thing to try to make money. They already had a lot of money and they were willing to be boring and get their excitement from doing other stuff, not from investing. My problem was I was an entrepreneur first, and then I wanted to get the same excitement from investing that I got from being an entrepreneur. And as a result, I made a lot of mistakes. Paul Samuelson, I heard about him years later. He was the first economist to win the Nobel Prize from the US. And he said, investing should be boring. It should be like watching paint dry or watching grass grow. If you want $800, he said, go if you want excitement, he said, take $800 and go to Las Vegas. So I learned a lot of hard lessons over the years. I learned that exciting speculative investment had lots of hidden costs, lots of roller coaster, lots of time glued to a stock ticker. And if you notice, people that do that, they don't enjoy real freedom. They're not really making money from money. They're making money from being really, really smart. And I started to study some of the really, really smart investors. Bill Gates and Warren Buffett said the smartest investment brain in the world was their friend Charlie Munger. So, what did Charlie Munger do? You would think if he's the smartest investor in the world and he sat, and he read like 500 books a year, he would be doing really complex algorithms and strategies and figuring out something really hard. Charlie said, my goal in life is not to jump over 8-foot hurdles, but to step over 1-foot hurdles. He said, if it's too complicated, I'm not even going to look closely at it. He said his greatest goal was to avoid repeatable mistakes. Now, think about that. How could you be more boring than just trying to study everybody's mistakes and avoid repeating them? But he and Warren did pretty well from themselves.
Yep.
If you, we all know Berkshire Hathaway's done really well, but a lot of people don't know how well. If you took Berkshire Hathaway's returns, if you took their stock price and cut it by 99%, meaning if it was $100 a share, you cut it down to $1 a share, it would still wallop the S&P 500 over the last 6 decades, significantly wallop. And so it's really important to study these smart guys. And Buffett, Munger, Howard Marks, others, they don't live by a crystal ball, and they don't try to. They realize they might be wrong, and they go through like a pre-mortem process to say, hey, if we're wrong, what are the things that are going to make us wrong here? Chris Davis from Davis Advisors, super successful investor. He has on his wall in his office, instead of their successes, they have all their failures plastered on the wall, like AIG Insurance, and then bullet points lists under the stock certificates. Here's the mistakes we made when we made this
Wow.
investment.
Wow.
And it's amazing to think that that is a better way to invest. But the tried and true investors have proven this. A lot of times they invest in boring assets. Sam Zell, the greatest real estate investor perhaps of all time, he, while nobody would even consider mobile home parks an asset type or an asset class, they wouldn't even talk about it. They wouldn't even put it on the charts and all the real estate things. He was quietly amassing 155,000 mobile home park pads quietly since the 1960s, while other people, they didn't even look down their nose at mobile home parks. They didn't even think about it. Yet, obviously, he's done quite well for himself. Mobile home parks are the only asset type that have a decreasing supply and an increasing demand every year. Self storage, what could be more boring than 4 pieces of sheet metal, a floor, and a door? Um, but these are the types of things these boring investors invest in. And whether they're in stocks, like I said, or in mutual funds, or in, whether you're in real estate, boring investing, not chasing shiny objects, keeping things simple. These are the kind of principles that I made so many mistakes on the first half of my career. And I'm doing everything I can now to do it differently and to help our investors do it differently.
It's funny. All my life, I've wanted two kinds of investments. I've kind of, as I've gotten older, I've kind of honed things down into generalities. And one of them is mobile home parks, and the other one is self-storage.
Oh,
Uh,
really?
yeah, I mean, those are the two real estate things that I would be interested in as I get a little older. But I find real estate for me to be really boring, which is playing
Yeah.
right into what we're going to be talking about. I'm more of a stock market guy, but I do it in a boring way. And I teach my students and investors that, look, if we're doing this right, we're doing it in a pretty boring way.
Yeah.
And what happens is the brain strays away from boredom, and tries to get you back into excitement because it's a dopamine hit like we hear about all the time with our social media. So
Right.
let's get back to how you do it and what you think is important in creating this boring kind of revenue stream. Because I'm a cash flow guy. I believe in cash flow, especially if you can get cash flow in a fairly boring manner. What
Yeah.
do you think?
It's so easy to think about like uh, there's this um there's this old story about sardine traders. And I'm going to see if I can find it real quick. I want to read it. I don't want to try to do it from memory and mess it up.
Okay.
The parable of the sardines. Years ago, there was a bubble in the sardine market. Speculators poured in, buying and selling barrels of sardines, driving the price up and up. One day, a speculator, having forgot his lunch, decided to open a barrel of sardines and eat some. They were disgusting, as he loudly complained to his friends. A particularly grizzled old trader responded, "Of course they're gross. Those aren't for eating, they're trading sardines." And the point is, if you're buying assets just to flip and just to, for appreciation plays, just hoping they're going to go up, they don't have any cash flow. They don't have any intrinsic value based on the cash they're throwing off. They're not creating true wealth, as I said at the beginning of the podcast. Then they're really speculation. And if they don't have any real value to eat, if you will, or they don't have any cash flow, as you said, Mark, the question is, what's their value? Well, their
Yeah,
value is based on what some real smart guy or foolish guy is willing to pay based on emotion. And a lot of these things are based on the emotions of Wall Street or a war in the Middle East or a tweet from Elon Musk, and if your wealth is based on those type of things, the question is that really investing or is it speculating?
sure.
And so our company tries to invest. We are investing in commercial real estate. These are assets that produce fairly predictable cash flow. These are assets that are generally, when the stock market went down, was it 20% a few weeks ago, and then back up 10 or 15% a few days later based on tariffs and such? Well, our assets weren't changed. They were still people renting these apartments and renting these self storage units and mobile home parks or mobile homes. And so the rent was coming in, the income was the same, and therefore the value remained unchanged. Of course, that's not always true. I mean, a particularly long boom or bust cycle is going to affect those things as well. But generally, they're not going to be seesawing up and down based on emotion. So we invest in boring assets like that. We also believe in diversification. Now, I'm writing a book about Warren Buffett's principles for real estate investors, and I got kind of mad at him because he made a comment. He said, diversification is generally for people who don't really know what they're doing.
It's
Mark
true.
Cuban said, diversification is for idiots. And I said, wait a minute, that can't be right. And then I looked just for a few minutes at Warren Buffett's company. I said, wait a minute, he's got 108 different companies diversified under one roof. He's got 108 different management teams, different asset types, different products. What Buffett was talking about is foolish diversification within one company. So if Dairy Queen, which is owned by Berkshire Hathaway, um, if they just said, well, we don't want to just do ice cream, we want to go out and build, we want to buy a manufacturing plant to build the containers, to create the containers. And therefore, we're going to need a pulp and paper company as well. And therefore, we're going to need to go back and buy millions of acres of timberland with lots of pine so we can have the pulp to grind up to make the paper. And we need to make ink as well to print we're going to make a penny more profit. That's stupid diversification. And I think that's what Buffett meant. Of course, broad diversification, having a team of experts with great products, best in class products in all these different arenas is a smart type of diversification. And that's what mutual funds do well. That's what Berkshire Hathaway has done so well. And so that's our goal as well. We feel Our company, Wellings Capital, goes out and we handpick the best operators we can find in self-storage, mobile home parks, RV parks, light industrial, commercial retail centers, and of course, multifamily. And we partner with them. We bring them equity and they go out and do their thing. Hopefully, they're buying really steep value add deals with a whole lot of meat on the bone, a lot of intrinsic value. Buffett says value, price is what you pay, value is what you get. And we're looking for assets that are in that mindset where, you can buy a self-storage facility and the owner says, "Oh yeah, we got 6 acres out back. We don't do anything with that." And there's room to do industrial outdoor storage there, or maybe do boat and RV rental, or maybe even build more self-storage units. And there's all kinds of intrinsic value things like that. Self-storage, I wrote a book on it. You can put a billboard on the property. You can put a cell tower on the property. You can put propane filling stations. You can even put an ATM. You can sell locks, boxes, tape, and scissors. You can rent RVs. What am I saying? You can rent U-Hauls,
U-Hauls, yeah.
trucks out of the self-storage facility. You can add, climate-controlled facilities. You can do all kinds of things once you have the self-storage facility. And so these are the value adds that can create a significant margin of safety between the debt and the income. And that growing margin of safety is what, really helps our investors sleep well at night when things are going bad, especially, on Wall Street and other places when things are seesawing up and down. This margin of safety, or in real estate, it's known often as the debt service coverage ratio, or it's measured by that, is a real help. And of course, it's going to eventually mean a lot of profit when the asset's sold. But we're not waiting till they sell. We're trying to create income along the way and growth and appreciation in the end as well.
Smart. And as you talk about Warren Buffett and diversification, one of my favorite quotes, and I don't know if I've ever read it somewhere, it just kind of crept into my brain, but that is to diversify among asset classes, but to concentrate within asset classes. So in other words, I
Uh,
believe that, if you're going to be an investor, or you're going to be spending any time doing something, you shouldn't be in strip malls, mobile home parks, storage units, McDonald's franchises, and all kinds of different businesses. Kind of to your point, you want to focus on something and get really good at it, I believe. So maybe you do have some self-storage and mobile home, but you can't be really good at both of them. So you need somebody maybe like you to be able to handle that. But you kind of have to. They're all different businesses, don't you think?
yeah, absolutely.
Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you can do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more.
Investors come to us because they want that. We looked at 745 operators and deals last year and only did 5 of them.
Wow.
And so, but here's the crazy thing, Mark. Every one of them looked great on the surface. Every one of them had a really nice website and a glossy brochure. And honestly, my old self, the 1998 version of me, would have used my FOMO and tried to invest in all of them
Yeah.
based on the fear of missing out. But the longer I've been at this, the more I've traded FOMO for FOMU, and that's the fear of messing up. And that's what Buffett and Munger have taught me really well. But investors come to us because they want us to do the deep due diligence. finding the right operators and deals, but they also want the diversification. They want to be able to give us, let's say, $50,000, and that 50,000 spread over maybe 100 deals in different asset types with different operators, each heavily focused on what they're doing.
So it sounds like you have a fund, and
Hmm.
that fund is the way that you get the diversification across the deal. So you're not actually going out there and raising money for a certain deal with a
Right,
certain investor. You might have a separate set of investors to get in those deals, but
right,
you'll give people a portion or a piece of the action or a piece of the pie
right.
to invest in your fund. Do I have that right?
Yeah, that's right.
Cool. So tell us a little bit about how that works. You know, where's the starting point and where's the finish line?
Well, we have an income fund and we have a growth fund. We used to try to fit it all into one fund, and that worked. But I think it works better to have an income fund and growth fund so an investor can choose, hey, I want 80% growth if they're, a 30-year-old doctor,
Yeah.
or, I might want 80% income if I'm a 60-year-old podcaster or whatever. But at any rate, they can invest in that. They can invest with us, and then we'll go out, and if it's an income fund, we'll theoretically, there's no guarantees, of course, start paying 5 to 8% income in the first few months, and they'll get that for the life of the fund. And then as assets sell, we often will recycle those into the fund, recycle, buy something else, or we'll distribute that cash flow. And of course, when the investor leaves, based on the net asset value, they'll be able to, if they cash in their chips in year 8 or whatever, they'll be able to cash in based on the current value of the cash flowing assets in the fund. That's
Is
the
this
income
only
fund.
okay? Is this are these funds only for accredited investors, or can anybody get in these?
Yeah, unfortunately, based on the SEC rules, it's for accredited investors only.
And that's changing, right? I mean, there's some bell ringing in Washington right now that they're trying to change that and make things a lot more accessible to the average person, correct?
Yeah, they've made it, between social media and the Jobs Act, it's become much more accessible since 2012 for the average person out there who had never even heard of these types of investments, syndications and such. But yeah, there's some talk of loosening those rules even further. Honestly, the accreditation process has already gotten easier than it was a few years ago. There are some options out there to become accredited, even if you're not a millionaire or earning 2 or 300,000 a year or more.
Right. Right. Well, this has been fascinating. It's nice to hear that somebody's doing funds for other people across different businesses, because a lot of people, frankly, on this show talk about apartments when it comes to real estate,
Yeah,
and apartments are great, but there are businesses that are even more boring, which is
right.
more exciting for me. Storage and
Yeah,
mobile homes, like I said, I think I'm fascinated by those two. So,
yeah.
how do people find out? I know you have a couple of ebooks. Maybe you could tell us where to get those, and how do people find out how to work with you and get to know you? And by the way, this isn't an endorsement, but everything that we talk about on this show and the other things that I do are about how to get started in researching and finding out about these things. And maybe it's for you, maybe, but it isn't. But Paul, tell us how people can be directed to you.
Yeah, they can get a hold of me at Wellings Capital. That's WELLINGS, wellingscapital.com. And if they want the ebook on self-storage, mobile home parks, other stuff, it's all free at wellingscapital.com/resources.
Cool. So you have some resources for people, and that's a good way to get to know you. And then I'm sure somewhere down the road, if people want to do something further with you, invest in and so forth, there's probably a phone call that's going to happen, I guess, right?
Yeah, right. That's exactly how it works.
Super. What would you say, as I'm putting you on the spot here, what would you say as we close out here? Maybe 2 or 3 points of tips that people can take away from your investing style, from the things that you've learned over the years, and then we'll say goodbye.
Well, one thing is whether you're, and this is going to offend a lot of your audience. I'm so sorry, Mark, but I live by this myself. Um, Charlie Munger said, "Why does the average person think that they have a particular propensity to picking stocks well?" And I would add, picking real estate deals well as also. He said he doesn't design his own um, gas-powered engines or build his own egg beaters, does he? And I just thought that was a fun way of saying it. Look, I mean, almost everybody I know who's actively tried to go into stock trading or picking, having a full-time medical career, 60 hours a week, and then trying to do real estate deals on the side, most of them have had a really hard time. They've had a lot of stress. They've made very low dollars per hour. A lot of them have lost money. And so I would say, stay in your lane. Do what you're really, really good at, what you're designed to do, and let other people's be expert and just trust them. And of course, it's really hard to find the person to trust, but that's one thing I'd say. I would also say imitate patterns, not outliers. Jesse Livermore, if you were alive 95 years ago, you'd know that name because he shorted Wall Street right before the great crash of October 1929. And he made, I believe it was like $4 billion in today's dollars. And a lot of people started imitating him. And of course, the day trading world was born. And I'm not saying people can't make money in day trading. I'm sure people do. But the average person with a job, a career, a life, a medical practice, whatever, they're probably not going to pull that off very easily on the side. Jesse Livermore couldn't even imitate his own success, and tragically, he took his life 11 years later in 1940. But a lot of people still imitate him. And, I mean, everybody I know that has had a full-time life, job, career, retirement, whatever, and tried to do that kind of stuff on the side, without fail, every single one I know has not succeeded. And I know
Yeah.
I've offended some people, and I'm so sorry, but I would stay in your lane, do what you're best at, and let other people do what they're best at.
I love it. That's great advice. Jesse Livermore, I quote him all the time.
Do you really?
Oh, absolutely. Probably the greatest trader of all time. Made and lost the equivalent of today's money, $1 billion 5 times before he killed himself. And but
Um,
there's a lot of things that you can learn from Jesse Livermore's trading style. And Jesse Livermore, at the end of the day, was unfortunately human, and made tons of money, and it also learned how to lose it really well.
wow.
So there's a lot you can learn from that. But it's true. I mean, it's the kind of thing that we do. Our human brains want to chase infallibility, and unfortunately, the markets are made by humans, and they're driven by emotion, and and it's tough. It's tough. You got to have a system. You have to have the right people like you, and people that have systems, and like Charlie Munger and maybe even Warren Buffett as well. So I think we'll leave it on that. That's a great note. Quoting one of my favorite guys, one of my favorite quotes from Jesse Livermore, he said, "You make the money not in the trading, but in the sitting. That's where the money is made," he said.
Uh,
So it's
okay.
sitting and waiting, these boring investments that you're talking about, Paul. You're not going to make your money by buying a self-storage or a mobile home park today and flipping it in 6 months. You're going to make it over 20 years where it gets paid off, and the rents go up, and it's managed properly, and it's accrued over
Right.
time. Boring investing, right?
Right.
Let's leave it on that. Thank you so much for being a guest on today's podcast. Your time, your wisdom was invaluable. And for those of you who are listening and watching, remember what I always say: never give up your power in your health, your wealth, or your time. Thanks for your time, and have a great day, everybody. See you next time. Take care.
You've been listening to the Wealth Architect Podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.